Good evening, ladies and gentlemen. Welcome to the Stock Market Brief Show. Holy moly, before we get into today's episode, which there's a lot to go over because, well, the election is right around the corner. We got market data coming out. The Fed, right, is going to be making their interest rate decision, which we pretty much already know what that's going to be. We obviously have earnings still going on too as well. Before we get on to that, there's a lot of good, juicy stuff going on Twitter or on X. Michael, the guy from ICT, said he's going to join a live stream. So he just said the time and the place. I put a live stream out there today to see if he'll show up. He did not show up. They only knew low delivery prices may redeliver for efficient delivery. Yes, that is a quote from what he said. The reason why we want him on a live stream, because I feel like it'd be important to clarify some of his concepts, which are general notions or ideas. Now, he had mentioned that we can do it November 11th, which is Monday next week. So I'm going to set up that stream. If you want to see the creator of ICT live with me, make sure to hold him accountable. He's already trying to back out a little bit. So he said, pick a day, pick a time. He said he'd show up. I picked the day, I picked the time. He said, okay. And then he said, send the link. And I was like, what do you mean send the link? We got to set it up on Zoom or Restream. And then he said, well, no, I'm not going to be interviewed. I said, well, let's not interview each other. Let's just talk markets. And he says, well, something about monetization. That's a no-no. And I said, let's turn monetization off. And then he's kind of just disappeared from that standpoint. But he said he'd show up in the comments and do tick-by-tick analysis, which is funny because he is well aware of what live streaming is and how there is a subtle delay on live streams. So I think the only way that we can have him on really, and actually have a good conversation about markets, talk about structure, whatever he wants to talk about. I don't even need to ask him a single question. I think the best way to do that is with a hot mic back and forth going. He doesn't need to even show his face on camera. That doesn't matter. But we'll see. November 11th, make sure to check that out. It's going to be 11 a.m. Eastern Standard Time. We will once again see if Mike shows up. I think he might just be in the comments and show up and just say, hey, look I showed up in the comments. But we'll see if he actually tunes in to the live. Let's get into the more important stuff because, well, honestly, I just wasted your time with that, in my opinion. Okay, the S&P 500 weekly expected move. It is gigantic this week because there's a lot of stuff coming out. It's $15. Now, if you don't know what the implied move is, right, this is using options chain to deliver a range of risk. Implied volatility, right? There's historic volatility, stuff that has already happened, and implied volatility, forward-looking. So the market is pricing in a $15 expected move. There's typically a 75% chance of tagging these expected moves any given week. And this goes based off of last year's data. So every week, 75% of the time, it was tagged. Now, we went 4 weeks without tagging. That's a pretty rare occurrence. And then we went ahead and we started tagging it, and we started giving larger expected moves. So the larger the expected move, the more likely it is to not tag, but given the context of the election, and then we also have the Fed stuff, I would be open to the idea still, obviously, of tagging the upper and or lower, which we can get more specifically into that stuff and how I plan on navigating this. Now, we are below a declining weekly 5 at EMA for the week. So right now, already, this tells me to lay my foot off the gas a little bit until the market starts to recover from its current run. I want to participate in the end of year rally if we're really going to get that November, December Santa Claus rally. You want to be a part of that, but you also want the market to prove itself before just entering in blindly. If you take a look at the heat map today, it was mixed board overall. You did see energy names kind of lead the way over there. That was the top performing sector out of the 11 sectors that make up the S&P 500. And when going into earnings tomorrow, one of the bigger ones is going to be Supermicro, which is down significantly because of a recent accountant from Ernst & Young, I believe it was, that left. So we'll see how that moves markets, more specifically, the various semiconductors that can trade in relation, that has a strong correlation to various other semiconductor names. Now, going into the remainder of the week, tomorrow we do have ISM Services PMI, which is a Tier 1 report, so that could potentially move markets when that is a drop. So be aware of that when it hits the tape. And then Wednesday, we have a bond auction. Thursday is the day where we get the Fed interest rate decision. The market has priced in a 100% probability that we're going to be getting a 25 basis point cut. So anything outside of that realm would be unexpected. And if we get something that's unexpected, the market can respond, more volatile. And then Friday, we have Michigan consumer sentiment. And during this entire time, obviously, we have the presidential election. Now, let's take a look at the various assets like the SPY, the Qs, IWM, semiconductors, biotech, and DIA. They are all below a declining 5-day moving average. So if you want to be the one to try to guess when this is going to recover, be my guest. But if you want to be the patient person and wait for price to resolve itself and see a series of higher lows and higher highs, and for the 5-day moving average to flatten out and turn back up and start trading for the change in potential trend, you would be more patient and you would kind of just take your foot off the gas here. These blue lines on the screen right here is actually the quarter-to-date anchored volume weighted average price. And I feel like this is going to be also an important level to continue to monitor to recoup, right? So if you look at Qs here, we broke down from it, declining 5-day moving average. We came back to back tested as holding as resistance. So if price is going to recover, right, on Qs, you'd want to see price get back above this. You'd want to see the 5-day moving average flatten out and start to turn back up. And you'd want to see something like this, right? Now, something more, stronger can potentially happen, but waiting for price to prove itself is incredibly important, especially in the realm of risk management. As far as semiconductors go, we are below the anchored volume weighted average price for the quarter, and we're below that declining 5-day moving average. The only one that's not is biotech, and biotech is above a rising 5-day moving average, above the quarter to date, and it's been rather choppy overall, but, it's holding up as it stands in this current moment. Okay, where are we in terms of gamma? The gamma flip line is roughly at about 57.80 right now, so we're in negative gamma territory. What does this mean? Well, it means that dealers, they're forced to sell into selling. This is known as dynamic hedging, and then buy into buying, okay? Which does what? It increases volatility. If you don't believe me, every time that we cross below the gamma flip line, which can be seen on this net gamma historic chart, you see that we're in the blue. I can go ahead and go over here to the VIX and show you in gray the times we're in negative gamma territory. When we go into negative gamma territory, volatility typically increases, including the time back here before going into August, right, which was crazy. Volatility increased. So when volatility increases, this is typically better environment for shorter term traders to play with intraday price swings. However, when it comes to swing trading, which is something that I do, I swing trade equities, you get a lot more fake outs, shakeouts. So what I like to do is I like to manage the positions that I currently have on while I'm in negative gamma territory. And if something arrives that I like, I'll take a position, but it's going to be smaller than my normal size position. And if it works, I will add to it. If it does not work, I cut it. Okay, that's how I keep my P&L curve for the, that's the hope, right? You keep the P&L curve by managing volatility like that, and you keep it more flat and less, swings, right? You don't want to be trapped in a volatile environment with an oversized portfolio or leveraged portfolio, because you will be dealing with larger swings on an intraday and daily basis. Okay, let's go ahead now and drop into the weekly moves. I'm going to show you SPY, Qs, and IWM. I shared this on the live stream. These are the implied moves for the entire week, which are quite large. So that 586.06, you can screenshot it. You can post these levels on your screen. Going into tomorrow's trading session, we have a daily implied move based off of 0-date data or 1-day expiration, right? We'll call it 0 DTE because that's what it really is going into tomorrow. And then we have the VIX implied move, which is the implied move based off of implied volatility, right? The VIX is the S&P 500 volatility index. And that level will give us, a range between the daily move and here. Now, the VIX doesn't use calculations this close to the options chain. So the reason why I like to do this is because it gives us more of a zone, whether to the upside or downside. But what I can tell you is this: if you think in terms of probabilities, there's a 68% probability that we close within this range. And sometimes when we get exaggerated moves into and around these levels or even outside of them, it can make for good intraday trades. So those are the levels going into tomorrow for SPY. For Qs, we have a weekly expected move up here at about 502.60, rounding it there. 472.22 below us. We are still below that declining 5-day moving average. And then we have our daily implied moves going into tomorrow right there on the screen. IWM, we have 220. I'm just going to round it to 228. Upper weekly implied move. Lower weekly implied move is 210. We are below a declining 5-day moving average, but it is rather flat, as you can see. The daily implied moves for the RVX, right? RVX is the Russell Volatility Index, and then the daily implied move based off of the options chain for 1 date or 0 DTEs. This is the range. Okay, so screenshot that, put those levels on your screen if you choose to do so. Now let's talk about volatility right now, because the here and now is very important. We can see that implied volatility, but more importantly, if we look at the VIX term structure, if we actually look at CBOE data of the VIX term structure, what you'll notice here is we're in what's called a backwardation, right? You can see the current VIX is at 19.45% or 19.45%, and then 18.69% on the next contract out, which tells us what? It tells us that there is more risk being priced in now than there is into the December contract. So the here and now is going to be more important. We know this because, well, we're in negative gamma territory. If you look at something like back month versus front month volatility, I do find this to be interesting. We are actually now cresting under 1.0. And what this tells us is that front month volatility, right, which we just pointed out on the curve here, is ahead of back month volatility. And if you go back through history and you look at the times where we've seen moves like this, it's actually marked out bottoming places for the market. And you can see the market rallies and or find some sort of a bottom. On the flip side, when you have back month volatility over 20% above front month volatility, it's marked topping spots like the most 2 recent times right around here, and then also right in around this level here where we kind of just consolidated and pulled back. So as the market is pulling back a little bit, this to me actually surprisingly looks bullish from that volatility perspective. So is volatility on the front month, right, the VIX, is that going to actually come down in the near future? And if so, does that mean that this line is going to start cranking towards that 1.2 level? I think that's something we got to watch out for and pay attention to moving forward. Now let's take a look at some other indicators. We have the bullish percent index. This is the NASDAQ composite bullish percent index. And the last time we talked about this really was when we spotted out the divergence on this specific chart. And if you go back through history, it's given warning signs that when we see these divergences, it's led to some market sell-offs, and then it led to what? Positive divergences, which led to potential market bottoms here. So we called it out, and the market's pulled back so subtly over here, and we haven't seen a bullish divergence take place yet. So all in all, I would say that this helped us determine that the market could take a little bit of a pause, and now I'd be watching for a potential positive divergence to form or some oversold conditions in the near future to potentially call that a bottom or the process of a bottom, and we could go from there. Other than that, I think we can move on from this specific chart. The bullish percent index for the S&P 500, when it is crossed down through 70, from above to below, we've seen turbulence in the market, and we've talked about these various divergences in the past that have occurred. Well, we crossed down through 70, the market saw some of a sell-off, and our RSI is now moving into this oversold condition. So once again, this right here is also somewhat bullish to me. Now, oversold can remain oversold for quite some time, so I personally like to look for divergences in the RSI to form, so something like that, for example. So that is something that I'll be watching for, but just note that already the RSI on the bullish percent index is moving into an oversold state. You go back through history and you can say, well, stayed overbought for about 2 months. Oversold over here, right? Stayed oversold for like over a month. And I would say, yep, exactly. So continue to watch it. BPINFO, this is the bullish percent index for the tech sector. And you can see here the negative divergence that is formed led to market sell-offs as well, including the most recent one in October. We had a negative divergence and the market has sold off a little bit. We are not in oversold condition and we do not see a positive divergence. Moving to bullish percent index for the New York Stock Exchange. It has reached a level, 29.59 on the RSI. So what does this mean? It's moving into an oversold condition. Is it fully oversold? Like, do we have a positive divergence? Can you act on this? In my opinion, no. But the market saw a negative divergence and we started to sell off. In fact, there was other aspects of this that we could look at, which we will in a moment. So the market here from a bullish percent index, from a breadth perspective, is now moving into that oversold condition. The DIA, same situation, bearish divergence where you had higher high print on the bullish percent index, Negative right there, move into oversold conditions. So we are getting some oversold conditions, both from back month versus front month volatility, from a bullish percent index perspective. So is the market gearing up for a potential rally? And if so, where? Well, that's why we talked about those weekly expected moves. Now, more importantly, I want to talk about a couple other indicators that match up to what I just simply said about the NYSE, right? The bullish percent index for the NYSE, how this had a negative divergence. Well, you can look at other breadth indicators too. And as the market was pressing higher, this one was clear as day that we saw a reading from 150 down to about 50 while the market pressed higher. And these divergences, you can just look back. I'm calling them all out. We've talked about these on these shows multiple times. It led to a sell-off. So here, it's not building anymore. It has played out to the downside. Now, on the flip side to this as well, you can look for positive divergences to form like we saw here, like we saw here, like we saw here. And well, I'm calling it out over here too. Over here, we saw positive divergence, right? So we've seen multiple times where we've seen positive divergences lead to moves higher in the market. So that could be something to watch for. It doesn't mean it's going to occur, but if it does occur, it gives us more ammunition, more ideals in the favor for a bullish price action. Okay? And you could also look at something like the NASDAQ McClellan Summation Index, and you can see the parabolic SAR has been very choppy over here. It's been giving sell signal, buy signal, sell signal, buy signal, sell signal, buy signal, sell signal. It's currently below zero. It's been like this for 5 or 6 trading days, and the market's been going flat. We also are getting a negative reading on the NASDAQ McClellan Oscillator. So what does that mean? It means that we just have poor breadth right now in the market, and you can look for positive divergences to form here. You can look for oversold conditions or overbought. So it's not giving us too much data overall from that standpoint. The last I want to touch on is the Sailor to Shift tool. This is what we use to really navigate the price of Bitcoin. And you get various buy signals, and the buy signal, right, is when the rate of change between Bitcoin and gold moves from a negative state to a positive state. We're looking at the 4-week rate of change. And then it gets a little bit more technical where you look at the weekly candles. I have the video if you want to watch the video and learn about it. But essentially, I drew it out on the screen. Every green line is the buy signal. Every red line is the sell trigger. Sorry, buy trigger and then the sell trigger. But there's various times where we do not get a trigger. And that's where you have to kind of know the strategy. The last signal that we've been on, right? We got the buy signal over here. The trigger happened here. When we crossed above the high, we saw a nice move from 60, I'm just going to round it up to 65,000 to 74,000. And now price is pulling back. We are still on a buy signal, buy trigger. And if this crosses back down beneath us, well, we will talk about it on today's video. That's all I got for you. There's a lot of risk in the markets. As previously stated, we went over some key levels and some of the indicators that are showing the market is in an oversold state. So get ready to rock and roll. See you later.